Contrarian investing is the art of going against the crowd. While most investors rush to sell when fear dominates the market, contrarian investors search for opportunities hidden within that panic, believing that excessive pessimism can push prices far below their true value. Few investors embody this philosophy better than Michael Burry, the physician turned hedge fund manager who famously predicted the 2008 housing market crash. Through his fund, Scion Asset Management, Burry built a reputation for uncovering deeply undervalued opportunities that others overlooked. His most famous trade, betting against mortgage-backed securities before the financial crisis, earned him roughly $100 million personally and hundreds of millions for his investors. Burry's approach is rooted in independent thinking, deep fundamental research, and a relentless focus on downside risk. He searches for companies trading at significant discounts to their intrinsic value, often concentrating his portfolio in a small number of high-conviction ideas across distressed industries. He has described his strategy simply: buy unpopular companies when they look like roadkill and sell them after they've been polished up. Beyond fundamentals, Burry also pays attention to market behavior, often looking for gradual bowl formations on stock charts that may signal a turnaround and the return of institutional buying. Yet conviction never replaces discipline. If an investment thesis breaks down, he is willing to cut losses quickly. At its core, Burry's philosophy is based on the belief that markets are not always rational, and that the greatest opportunities often appear when everyone else is looking the other way. The challenge, however, is psychological. Being a contrarian means standing alone, sometimes enduring months or years of criticism and losses before the market finally recognizes the value you saw all along. What separates Michael Burry from many investors is not simply his willingness to disagree with the market, but his obsession with understanding risk before chasing reward. He spends countless hours studying financial statements, industry trends, management decisions, and market structures to identify situations where the downside is limited, but the upside could be enormous. Rather than asking, "How much money can I make?" Burry first asks, "What could cause me to lose money?" This mindset allows him to remain patient while others react emotionally to headlines and short-term price movements. His success during the 2008 financial crisis was not the result of a lucky prediction, but years of research into mortgage lending standards, borrower behavior, and the hidden vulnerabilities inside complex financial products. Burry understands that markets can remain irrational for long periods, which means being right is often not enough. You must also survive long enough for your thesis to play out. This requires emotional resilience, intellectual independence, and the ability to tolerate being unpopular. In many ways, contrarian investing is less about predicting the future and more about recognizing when the crowd has become excessively optimistic or pessimistic. By remaining disciplined, focusing on intrinsic value, and refusing to follow consensus thinking, Burry has built a career around finding extraordinary opportunities precisely where most investors are unwilling to look.